Once those tricky first years with common cash flow challenges bed down into more of a rhythm, the business is better able to become more proactive with tax planning. Pat and John's business is producing improved profit, which is helping them derive more income for themselves, and they want to maximise their after-tax dollars. They're also learning how to deal with an expanding team and how to keep on top of payroll and their employer obligations.
What's the benefit of tax planning and when's the best time to do it?
Yes, so it might be helpful to think of your business as almost having three different types of profit. There's your cash profit, of course, so that's the amount that your bank balance goes up and down every period. There's your accounting profit, the number at the bottom of your P&L in your accounting system, but there's also your tax profit, and that's the number that goes in your tax return at the end of the year. And it can be quite different to the other two numbers. So tax planning comes in to help you work out what that tax number is and work out your tax liabilities across your group. And sometimes more importantly, when those tax liabilities fall due. So it's particularly important to managing your cash flow when you're on the pay-as-you-go installment system. The ATO might be sending you tax installment notices every few months, but those could be based on data that's over 18 months old in some cases. So if you've got your tax planning up to date, you can vary those installments closer to what you think they should be and pay the right amount at the right time. If you're drawing money out of the business, tax planning will help you work out and balance your tax liabilities across your business and your personal tax returns. And if you have a trust in the mix, then it almost becomes a compulsory exercise. When might you do this? Well, it's good to have your accounting data up to date, and you should sort of, every time you sit down to discuss this sort of thing, it should be an item on the agenda. You might, up front, you might need to make decisions about how and when you invoice. But generally, you would do a full exercise in tax planning around budget time, so May, maybe even sooner. That's when you might decide things like, should I buy or sell this capital gain asset? Should I put up some more money into super? Or is there some more things with the business where I should defer some income or bring forward some income or expenses, maybe invest in assets and equipment a little bit sooner than I might otherwise? First and foremost, though, these things all have to make commercial sense from a business point of view.